All right, welcome everyone to another episode of Give Me Some Truth International Edition. I'm still Michelin. I'm joined by Stan Farmer today.
Hello.
And I think some of you may have listened to our last podcast about changes happening in the UK as it relates in particular to remittance-based taxation and all the tax benefits that people in the UK have enjoyed under, the res non-dom taxation regime, and how some of that is changing or has changed, right?
Yes.
And so one thing we said in that podcast is we would try to update our listeners as new details become available and as we become a little bit more confident with some of the granular details of implementation. And so Stan wanted to give us an update today on what I think are some of the more interesting changes happening, in particular things that relate to a situation that's very common for Americans in the UK, is a situation where maybe you're a res non-dom in the UK, and maybe you've been using remittance-based taxation, but maybe what you have as far as your assets in the US are what's called a mixed fund in the UK, right?
Yeah.
Where, you've not been segregating capital income. You no longer have the ability to decipher, what is clean capital versus, what has been commingled with untaxed, unremitted income. So there's a lot of complexity associated with that, and it keeps a lot of UK accountants, very busy and very wealthy. But the good news is that there are provisions in the new laws that were introduced at the end of last year that may provide a path forward for people whose finances are maybe a little would otherwise be a little messy from the perspective of kind of UK remittance-based taxation. So help me with the acronyms here. I think there's.
So remittance-based is sloppy, right?
Yeah.
Because you've had lots of transactions, voluntary and involuntary. You've received dividends, you've received interest, you've maybe realized gains in some years, not others. You might own mutual funds that right. To say nothing of the fact that you might have, some of those might have been UK reporting funds, a whole other topic, and some might have been non-reporting funds.
Right.
So you've got different classifications, and maybe you've taken some IRA distributions, right?
True.
So you might have just this plethora of entangled income that then has been turned over into new investments and then has been, producing more income. And so in each previous UK tax year that you were a remittance-based taxpayer, you have created FIG. And what do I mean by FIG? Apparently this is a new acronym from the UK, Foreign Income and Gains. Maybe that's not a new acronym, but the window of opportunity that we are going to focus the spotlight on a little bit today is the TRF, the Temporary Repatriation Facility.
Okay.
So what this is an ability to possibly clean up that unremitted income and remit it, whether you physically remit it or whether it stays in your U.S. accounts or elsewhere, right? It's a chance to kind of cleanse what is a very complicated situation when you're trying to calculate your tax liability every time you do repatriate going forward income to the UK, right? So the TRF is intended to encourage former remittance-based taxpayers to go ahead and declare and or physically remit previously untaxed FIG, foreign income and gains. All right, so the incentive here is that you get a reduced rate if you are making these declarations under this TRF. And the T in the TRF stands for temporary, right?
Okay.
So this is a window of opportunity to get a reduced rate of taxation on all declared and at least putatively remitted FIG, whether it be capital gains, interest, or ordinary income, right? And that reduced rate will be, under the TRF, taxed at a rate of 12% in this upcoming tax year that begins April 6, 2025, and ends in April of 26. It will also continue to be 12% in the following UK tax year that begins in April of 26 and ends in April of 27. And then it goes up to a final third year, which I think was not in the original proposal, but ended up being added. But it'll be at 15% in that third year, covering April 27 through April 28.
Okay.
And then you're screwed. Okay. So
then it's over.
So act now.
Right.
Okay. So also consider the fact that, 12% and even 15% is attractive for unremitted capital gains because the capital gains tax has now gone up, right? Going forward, if you don't take advantage of this, you'll be looking at either the 18% tax bracket or the 24% tax bracket on your UK taxable tax capital gains. And you'll be looking at, obviously even higher tax rates likely if you're remitting non-reporting fund income, and if you're remitting other ordinary income, right, or income that's subject to ordinary income tax rates.
Right. Okay.
Because the UK has, rapidly rising marginal tax rates relative to the US, right? So again, there's no need to physically remit the funds in the year that you're taking advantage of the TRF. You just must make an election on your tax return, and the deadline to elect and designate such FIG is apparently January 31st following the filing deadline. So I'm not sure what that means exactly, the mechanics of all of this. And I think that highlights a need that, an overall disclaimer that we're going to put on everything that we have to say about UK taxes and the TRF and the FIG and everything else. And that is that, you desperately need to be working with a UK tax preparer as you work out the details or the ministerial tasks of taking advantage of this. To avail yourself of this program, you need to figure out what your unremitted tax liabilities are, how much FIG you have hanging on the tree, so to speak, and then you have to, work with that accountant and map out a strategy on how you're going to cleanse the FIG with this effervescent lower tax rate. Okay, so also, you must pay this tax using the TRF with clean capital.
Oh, okay. I didn't
so
realize
you can't
that.
use your dirty FIG to cleanse by paying with unremitted capital, right? Or income, right? Can't use unremitted FIG to pay your taxes. It's got to be clean. And then the ordering rules, which are, a 6-part podcast in the future that hopefully I'm not around for. Very complicated stuff. Understand that they've been amended by this new program as well, so that designated FIG is always deemed to be remitted first when you thereafter physically make remittances to the UK. So if you've designated it and you've paid the tax, for whatever amount of income it is, say, $25,000, but you've got $50,000 in FIG that you didn't utilize, you didn't designate, right? The first $25,000 that makes its way from various financial institutions to the UK, that's not going to be taxed
So
again.
that's an important, okay.
But then, you've got this remaining income, and it doesn't matter what year in the future it comes after you've used up the money that you've cleansed with this program. Then you're looking at remittance basis, at ordinary UK income tax rates, or the new UK capital gains tax rates.
So would you say that you really have an incentive to do it on the entirety of your offshore wealth? Right?
Yeah. I mean, I think the fact that they're giving you this 3-year window gives you a chance that you don't have to do it all at once, right? So that you can kind of, you can take the pain out several years, because maybe this is going to involve also your U.S. taxes and maybe bump you into a higher gains rate, or trigger you to be, because you now got this window of opportunity until April 6th. You've got the remainder of this tax year to take further advantage of this, which we can get into, by intentionally creating capital gains while you're still a remittance-based taxpayer. Good for the UK, because then you can bring it in on a fig at a lower capital gains rate. Good for you in perhaps, but from a U.S. standpoint, obviously, you have to consider the consequences of huge gains. It might bump you from like the 15% capital gains tax rate to also, not only the 20% capital gains tax rate, but the HCA surcharges or whatever. Probably still worth it under any imaginable circumstance.
Yeah, absolutely. So the clock is ticking. It's a great opportunity that you now have, if you're in the UK, to really clean things up and start fresh. So be sure to talk to your UK accountant about how to take advantage of the TRF facility, and also speak to your US accountant about handling the implications of that as far as capital gains, tax credits and things of that nature. But certainly a very important topic and a real highlight for Americans in the UK about, all the changes that have come into effect. This is really one of the more important one, and I think it really warranted an additional podcast. So thanks for this update. We're out of time for today, but as new details start to emerge, we're going to continue to update our listeners about any opportunities.
I mean, really, if you've been a UK remittance taxpayer and you have unremitted foreign income and gains, and you want to talk about what this all means for you, the time is now. Yeah. Right.
Absolutely.
Maybe you reach out to us, maybe you reach out to another investment professional. You certainly should reach out to your UK accountant. But the window to start strategizing about this is now. And if you've got, a mixed account where, you've got gains from various years, this might be, a magical opportunity for you to clean this all up at very favorable rates and take out a lot of complication. I know that just this facility sounds complicated, but not taking advantage of this facility and having unremitted is even more
a lot simpler
complicated
than the alternative, which is having to deal with ordering rules and things of that nature.
Yes. So this is a magical period of opportunity to get this all straightened out. I just wanted to get that in, and I'm sure we'll talk about this more as things crystallize with regard to how this new UK tax regime is going.
Absolutely. Yeah. Thanks a lot, Stan, and thanks everyone for listening. And we'll see you next time for another episode of Give Me Some Truth International. Be sure to like and subscribe. Thank you.
Walkner Condon Financial Advisors is a registered investment advisor with the SEC. Registration with the SEC does not imply a certain level of skill or training. The opinions expressed by the participants of this podcast are their own and do not reflect the opinions of Walkner Condon Financial Advisors. All statements and opinions expressed are based upon information considered reliable, although it should not be relied upon as such. Any statements or opinions are subject to change without notice. Information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk and, unless otherwise stated, are not guaranteed. Information expressed does not take into account your specific situation or objectives and is not intended as recommendations appropriate for any individual. Listeners are encouraged to seek advice from a qualified tax, legal, or investment advisor to determine whether any information presented may be suitable for their specific situation. Past performance is not indicative of future performance. Thanks for listening, and for further information, please visit WalknerCondon.com.